Good afternoon, everyone. We'll go ahead and start while others join. Thank you very much for joining this earnings update for Hela Holdings, covering our second quarter results. My name is Adam Collins, General Manager of Corporate Affairs and Investor Relations for Hela. I'm also joined today by our Group CEO, Talanka Junadasa, our Group CFO, Mr. Maurice Ramanji, and Deputy General Manager of Corporate Finance of India, Sarah. To outline the agenda for today's call, we will start with a brief presentation of around 15 minutes, focusing on the latest financial results, which were published on Monday. We will then move on to Q&A for the remainder of the session. Questions can be shared through the Q&A box on your screen, and we would encourage you to do so throughout the call. You will also be able to unmute yourself during the Q&A session as well. And just to note, we will also be sharing this presentation by email following the call. Just before we start, a quick disclaimer on forward-looking statements. Any such statements are based upon the management's current reasonable expectations and assumptions and are subject to known and unknown risks. Given the risks and uncertainties that may cause the company's actual performance to materially differ from that expected or implied by these statements, we advise you not to place full reliance on them. We also do not undertake any obligation to update these statements to reflect future events if circumstances change. So to move on straight into the main presentation, this initial slide provides a snapshot of the quarter's results. And overall, it was a resilient quarter. Revenue of 28.2 billion represented continued growth year on year, both in LKR and in USD terms. So in LKR terms, it was 89%, and in USD terms, it was 5%. And this supported the improvements seen in operating profit and profit after tax. We also saw some improvement in margins, though, as the slide shows, this performance was somewhat mixed. So we saw a 20 basis point improvement year on year in the gross margin to 14.6. But year on year, the EBIT margin did contract. And I'll touch kind of on the reasons for that in the subsequent slides. But I should say that on a quarter basis, there was a marginal improvement in the EBIT. So the positive trajectory we saw in margins in the first quarter did continue to some extent in the second quarter as well. Finally, the balance sheet position continued to strengthen, and we saw further reductions in the net debt to equity ratio, which reduced to 1.6 as of September, compared to 3.9 in the previous year and 2.0 in June. This, of course, is reflective of the debt settlement carried out by using the IPO proceeds, but there has also been an improvement in the working capital cycle, particularly as a result of reduced inventory and receivable days. To jump into the quarter performance in more detail, I won't go through this slide in great depth because I covered some of the points in the previous slide, but just to highlight a few items, firstly on the revenue side. We definitely are seeing a softening in the exceptional consumer demand that we were seeing in previous years in our key markets in Europe and North America, particularly as a result of the higher inflation and tighter monetary policy in those markets. But I think overall during the quarter, we saw a continued positive influence from some of the new customer relationships we've established, which we mentioned last quarter, and also the continued ramp-up of our Egyptian operations. And to illustrate that, I think this chart on the right-hand side does a good job. So this shows the breakdown of revenue by the country of manufacturing, and the inside circle shows that split in the second quarter of last year, and the outside circle shows split in the most recent quarter. So really the kind of key changes you're seeing is the impact of Egypt, which is now in the most recent quarter accounted for 5% of revenue. And you'll see Kenya taking on a bigger portion as well. It's leaving Sri Lanka at about 50%, which is really a continuation of the trends we've seen in recent quarters as well. In terms of profits and margins, as mentioned, there was a limited improvement. And the major constraining factor was an increase in distribution costs, which I'll come to in more detail in the subsequent slide. And this was only partly offset by a rise in other income and gains, which was driven by a couple of one-off factors. The other kind of key point to highlight is that we did see kind of positive improvement in administration costs, specifically in USD terms. We saw administration costs coming down, which is both the reduction of pandemic-related costs, and also the positive impact of the depreciation in the Sri Lankan rupee on our local overheads as well. To move on, this slide puts the quarterly performance in context. I won't dwell too much on it, as it is distorted by the depreciation in the rupee, though it does underline the overall picture that this was a fairly robust quarter, the one where we would say there is definitely scope for further improvement, particularly on margins. And I think I will put this more into context on the next slide, which takes a step back by looking at the first half of the year as a whole. So this chart shows the H1 performance in each of the past 3 years. And importantly, this is shown in US dollar terms to extract from the exchange rate impacts. The absolute US dollar revenue is shown in the bars, which are split into revenue generated from manufacturing in Sri Lanka in the dark blue, and revenue generated from Africa in the light blue. So based on these, that trajectory in terms of revenue growth is clear on this basis. It is slower than it was in the previous year, but I would point out that that first half of FY21 was the most COVID impacted couple of quarters there. The lines on this chart then show the movements in both gross and EBIT margin. So what we saw in the most recent first half was some improvement in the gross margin, not back up to the levels that we were seeing in the first half of FY21, but still some improvement. The picture on the EBIT side is a little bit more complex, where we've seen it drop very slightly. And really, as I'll come to in the next slide, one key driver of that drop has been an increase in distribution costs, which has largely been driven by additional air freight, unplanned air freight costs, which I will explain in a bit more detail in the next slide. So this slide is aiming to dive a bit more into detail on the distribution costs. And what I'm showing on the chart on the right-hand side is the group's distribution costs in each of the past 4 financial years in the light blue bars, and then in the most recent first half 6-month period in the dark blue bar. And then the line shows the distribution costs and the share of revenue. And really the takeaway from this chart is that in the past few years, distribution costs has averaged around 2 to 2.5% of revenue. It did go up last year, but that was partly due to the big jump in revenue we saw as well. But in the first half of this year, we've seen a much larger increase in distribution costs, to the extent where, and this is in US dollar terms, our distribution costs in the first half already exceed our distribution costs for the full year of last year. And the reason for this, or a big reason for this, is unplanned air freight costs, which I've sought to highlight on this chart, which was a total in the first half of about $4 million, which is I've tried to isolate out using the red dash line. And then the yellow dash line is showing how this what the share of revenue would be if we excluded that air freight cost, which brings it down to about 2.2% of revenue. So that's essentially coming straight off the bottom line, that essentially 3 percentage points taken off the EBIT margin because of this. And the reason for the air freight is primarily the knock-on impact of the labor disruption we had at our Kenyan manufacturing facility in February, whereby that disrupted production, and then the knock-on impact on catching up production led to some of these unplanned air freights, as well as it was partly due to some of the economic instability in Sri Lanka. Most importantly, and the important reason why I'm taking some time to go through this is that we are seeing those operational disruptions reduce significantly. So we do expect this amount being spent on air freight to reduce in the coming quarters. And that is one reason why we believe there is further significant scope for margin improvement in the coming quarters. Because we remove this cost, it in itself, in addition to all the other measures we are taking, will have a significant impact on EBIT and also the PAT margin. Moving on to the outlook. So I think as is well known now, we're certainly seeing a slowdown in consumer demand. And that impact on us as a manufacturer is being felt partly also because that's leading to an increase in inventories across major apparel brands. And I think our expectation for the second half of the year is that we will see a revenue softening, certainly in US dollar terms. It will still be up in Sri Lankan rupee terms, but certainly in US dollar terms. Though we are expecting our Egyptian manufacturing facility continuing to ramp up, and then the new customer relationships acting as mitigating factors in this environment. And as I mentioned on the previous couple of slides, we do see further significant scope for profit margin improvement, which will support earnings in the future quarters, even in the context of a softening demand environment. I think key risk factors are, of course, that the slowdown in consumer demand is deeper and more prolonged than we're currently expecting. There is a great deal of uncertainty about how the demand environment is going to play out in the next couple of quarters, and then how long it will take to fully return to a more normal level. Another potential risk factor we've seen is policy changes in some of our key operating countries. So, I mean, most of us will be aware of all the policy changes taking place in Sri Lanka, but in Kenya and Egypt, they have both, just in the last couple of weeks, signed staff level agreements with the IMF. So we do expect some policy changes coming out of there. The important caveat to that is they are in a much less severe situation than Sri Lanka, so we wouldn't necessarily expect some of those changes to be dramatic, as dramatic, particularly on the tax side, as we saw in Sri Lanka. But we have seen things like a quite significant depreciation in the Egyptian pound. So there are factors going on there to watch. And then finally, a further significant increase in global interest rates is definitely a risk in terms of our finance costs going forward. In terms of how we're seeking to navigate through this period, it's really probably a two-pronged approach. So the margin improvement strategy is really a very important part of that, and focusing on operational excellence and reduction of waste, including reduction of air freight costs, is an important means to achieve that. I think one flip side of the drop in consumer demand is we have also seen a reduction in major global commodity prices and freight charges, which is something we are continuing to seek to capitalize on. And I think overall, going through this period, we will be remaining agile in terms of our decision making as to how to approach and navigate through this period in terms of ensuring margin protection. I mean, the other prong of this strategy is really focusing on continuing to strengthen our customer offering. We are continuing to see a lot of customer interest in Egypt, so we will be focusing a lot on how to maximize the benefit of that and building the business from there. In addition, we'll continue to, of course, seek to add to our capabilities during this period and strengthen that overall value proposition so that we are strongly placed as demand also starts to improve in the future. And kind of one final part of this I want to highlight on the margin side is in October, we had the initial stage of our go live of SAP, which went live in our kidswear cluster. So that is a significant progress in one of our key IPO objectives. And the real benefit of that is it will provide us with a robust digital core that seamlessly integrates all the different digital systems we have across the group, really allowing for that greater agility, greater data-driven decision making, which will be an important support to the operational excellence journey and overall supporting that margin improvement going forward. Those are really the overall key messages that I wanted to communicate today. I have a couple more slides on our community empowerment and environmental work, but as I said, we will send across this deck to you all after this call. And of course, if you have any questions specifically on any of these issues, please feel free to let us know.